Have you ever wondered why stock sometimes keeps moving higher even when the latest results look weak? Think about that for a moment. Imagine you own a premium restaurant in a busy city. One quarter, fewer customers walk in. Revenue falls. Profits come under pressure. Yet, when you look closely, you notice something interesting. The richest and most experienced investors in town are quietly buying stakes in your restaurant. They aren't focusing on today's crowd. They are thinking about what the restaurant could look like when the city becomes busy again. That is the puzzle we are trying to solve today. And to understand it, we need to begin not with the company, but with a larger story unfolding across India. Over the last few years, the Indian government has aggressively pushed manufacturing, exports, infrastructure development, and global competitiveness through initiatives such as Make in India, production-linked incentive schemes, logistics improvements, and efforts to position India as an alternative manufacturing destination for global supply chains. Now, at first glance, you may wonder what all this has to do with a company that sells quartz and granite surfaces. Actually, quite a lot. Because whenever a nation wants to become a manufacturing powerhouse, companies that own resources, processing capabilities, export relationships, and global distribution networks suddenly become strategically important. This brings us to Pokarna. Pokarna operates in the building materials and engineered surfaces industry. More specifically, it is one of India's leading exporters of premium quartz surfaces, products that eventually find their way into kitchens, bathrooms, commercial spaces, hotels, and luxury residential projects across the world. Think of quartz surfaces as the finishing touch of a modern home. When someone spends money renovating a kitchen, upgrading a house, or building a premium residential project, they're often not buying just a stone slab. They are buying appearance, durability, aesthetics, and lifestyle. That is the industry Pokarna serves. Now every sector has both tailwinds and headwinds. A tailwind is like a strong wind pushing an airplane forward. It helps progress happen faster. A headwind is the opposite. It pushes against growth and makes the journey harder. The long-term tailwinds for this industry are easy to see. Urbanization continues across the world. Premium housing demand continues to rise. Consumers increasingly prefer engineered quartz over traditional materials. India is becoming a stronger manufacturing alternative for global buyers. And the total addressable market, often called TAM, remains enormous. A TAM, or total addressable market, is simply the size of the opportunity if a company could serve every potential customer in its market. Imagine opening a tea stall outside one apartment building versus owning tea brands across an entire country. The second opportunity has a much larger TAM. Pokarna operates in a market whose opportunity stretches across global construction, remodeling, hospitality, commercial interiors, and residential housing. But while the long-term story looks attractive, the short-term story looks very different. And this is where investors must separate the weather from the climate. Weather changes every day. Climate changes over years. Many investors confuse the two. Today, the weather is challenging. The company's biggest market is the United States. And right now, the American housing and home improvement market is experiencing uncertainty. Interest rates remain elevated. Homeowners are delaying large remodeling projects. Kitchen upgrades are being postponed. Tariff discussions continue to create uncertainty. Competition has intensified. Prices are under pressure. Management itself has openly acknowledged these challenges and has adopted a cautious tone. Whenever management becomes cautious, investors should pay attention. Management teams see order books before investors. They hear customer conversations before analysts. They understand industry conditions before quarterly numbers fully reveal them. Yet something fascinating is happening. Even while management sounds cautious, institutional ownership continues to increase. Why? To answer that question, we need to understand a powerful mental model called second-level thinking. Most market participants think, sales are down, profit is down, therefore stock should fall. That is first level thinking. Second level thinking asks, why might smart money be buying despite weak earnings? This is where things become interesting. Experienced investors often focus on earnings power rather than current earnings. Earnings power means what a business can potentially earn when conditions normalize. Imagine a luxury hotel during an economic slowdown. Occupancy falls. Profits shrink. But the hotel itself hasn't become worse. When tourism returns, occupancy rises again. The earnings power was always there. The temporary weakness was merely hiding it. Many institutions appear to be viewing Pokarna through this lens. Now let's connect this with another important mental model: capacity utilization. Imagine you own a factory. Whether the factory runs at half capacity or near full capacity, many fixed costs remain the same. When utilization improves, profitability often grows faster than revenue. This is called operating leverage. Operating leverage is one of the most powerful wealth creation engines in manufacturing businesses. Small improvements in demand can create disproportionately larger improvements in profit. This is one reason sophisticated investors monitor cyclical companies carefully. Now let's talk about valuation. Most retail investors use only one valuation framework: pay ratio. But professional investors rarely stop there. They examine multiple lenses. The earnings multiple model asks whether the market is paying too much for current earnings. The PEG model compares valuation with growth expectations. The book value approach evaluates asset backing. The discounted cash flow model estimates future cash generation. The replacement cost model asks what it would cost to recreate the business from scratch. The earnings power value model focuses on normalized profitability. The sum of the parts model values each business segment separately. The enterprise value framework considers both debt and equity together. Each model tells a slightly different story. And when multiple models start pointing towards similar conclusions, conviction increases. Currently, some valuation models suggest optimism is already reflected in the stock price. That means investors are not paying for today's earnings. They are paying for a potential recovery. This creates an important psychological dynamic. The market is essentially voting on the future, and that future depends on whether demand eventually returns. Now let us shift from fundamentals to market behavior. When many investors hear the word technical analysis, they imagine charts filled with lines and indicators. But technical analysis is really the study of human behavior. Every price movement represents a decision. Every decision reflects fear, greed, conviction, doubt, patience, or urgency. Think of a stock chart as a visual record of collective human psychology. When a stock remains resilient despite weak news, it often suggests that stronger hands are absorbing supply. When institutions continue accumulating while public participation declines, it sometimes signals that informed investors are focusing on future outcomes rather than present difficulties. This doesn't guarantee success, but it provides an important clue. Remember, markets are discounting machines. They attempt to price tomorrow before tomorrow arrives. That is why price sometimes improves before earnings improve. The market often moves first. The financial statements catch up later. This brings us back to management. What is management actually saying? Management is not promising explosive growth. Management is not predicting immediate recovery. Management is emphasizing discipline, protecting relationships, maintaining quality, managing pricing carefully, navigating uncertainty. In investing, this matters. A management team that remains realistic during difficult periods often earns more credibility than one that constantly promises extraordinary outcomes. And perhaps that is the most important lesson from this entire story. Pokarna today is neither a pure growth stock nor a distressed turnaround. It sits in an interesting middle ground, a market leader facing cyclical headwinds, a fundamentally sound business navigating temporary challenges, a company where management sounds cautious but institutions continue accumulating. A stock where current earnings look weak, but future earnings power remains attractive. So before we end, let me leave you with a thought. If demand recovers, if remodeling activity returns, if capacity utilization improves, and if management successfully navigates current challenges, what might this business look like a few years from now? And equally important, what if the recovery takes longer than expected? Because great investing is never about finding only reasons to buy. It is about understanding both possibilities clearly. The next time you see a stock rising while earnings look weak, don't immediately assume the market is irrational. Ask yourself a different question. Is the market seeing tomorrow before I can? That single question may completely change how you look at businesses, charts, management commentary, valuation, and opportunity itself. And perhaps that is the real story behind Pokarna.
Don't forget to like and subscribe.